Hey everyone, welcome back to Corporate Decoder, the place where we dissect the big corporate moves and try not to get lost in the legal jargon. Today we are diving into a filing that smells like a cash infusion and a bit of a financial juggling act. Buckle up. So this is a current report from PAVmed Incorporated filed on the 3rd of February 2026. The earliest event reported was on that same day. Basically, it's a heads up about some pretty significant things they've been up to. PAVmed Inc, which is incorporated in Delaware with the stock market ticker of PAVMAM, is telling us about a big new deal they've entered into. Item 1.01 talks about them entering into a material definitive agreement. This is where they sold some new stock and warrants to investors for a total of $30 million. They sold 30,000 shares of something called Series D convertible preferred stock, and also gave investors warrants to buy another 30,000 shares of this same preferred stock. For every $100,000 an investor put in, they got 100 shares of this preferred stock and a warrant for 100 more. Now this Series D preferred stock has an initial conversion price of 6.50 per S-share. This means that investors can convert this preferred stock into common stock of PAVmed Inc at that price. The price can change though if the company does things like stock splits or pays out stock dividends. Here is where it gets interesting. At the same time they did this offering, they also paid off all of their Series C preferred stock, which was about 16,962 shares. They also refinanced a big chunk of money, $8,414,890 from a senior secured convertible note that was issued back in 2022. They paid off this debt with about $22,346,241 in cash using some of the money they just raised from the new stock sale. In return, they issued a new note, the 2026 note, for $15 million. So they took debt, paid it off with new money, and then issued new debt. This is a classic move to restructure their financial obligation. Let's talk more about this Series D preferred stock. The company filed a certificate of designations to lay out the rules for this Series D preferred stock. It's ranked higher than their common stock, meaning if the company goes under, the Series D holders get paid back before common stockholders. However, it's on the same level as their Series B preferred stock. Holders of this Series D preferred stock can choose to convert it into regular company stock. The common stock, the basic idea is that for every $100 of stated value in their preferred stock, they can get common stock based on the conversion price at that time. This preferred stock will automatically convert into common stock if the stockholders approve it, or if the company decides stockholder approval isn't needed according to NASDAQ rules. They are planning a stockholder meeting to get this approval. There is a limit here though. Investors can't end up owning more than 4.99% of the company's common stock after converting their preferred stock. This means they can't suddenly take over a huge chunk of the company through this conversion. They can sometimes increase that limit up to 19.99%, but only if they declare it beforehand. This is a big one, starting in February 2029 or sooner. If certain bad things happen, holders of this Series D preferred stock can force the company to buy back their shares, and not just for what they paid, but for a multiple of it. If they demand redemption soon after the stock is issued, it's 300% of the stated value. If they wait a year, it goes up to 400%, and after 2 years, it's 500%. So if the company isn't doing well, or if investors want their money out in a big way, they can demand a significant payday. Now let's look at the warrants. These are basically options to buy shares of Series D preferred stock later. They expire in 2031. To raise a special condition here related to their subsidiary Lucid Diagnostics Inc. If Medicare decides to cover a product called EsoGuard, the company can then buy back these warrants for next to nothing. Just 1/10 of a cent per S-share. This is a way for PAVmed Inc to essentially take away the warrants from investors if a key product gets regulatory approval. They also signed a registration rights agreement. This means the company has promised to file paperwork with the SEC to make sure that the common stock investors get from converting their preferred stock can be legally resolved on the market. And then there is the 2026 note. The new $15 million note we talked about earlier. This new note gets 15% interest per year, which is pretty high. It's due in February 2029, but the note holders can extend that date if certain things happen. This debt is secured by pretty much everything the company owns and will own in the future, except for the assets of its subsidiary Lucid. This means if the company defaults on this loan, the lenders can seize most of their assets. If something goes wrong in event of default, they can demand their money back plus an extra 115%. So if things go south, the debt holders get a bonus payout. Speaking of defaults, this note includes events of default such as breaking promises, or if key executives like the chairman CEO Lishan Aklog and the president and CFO Dennis McGrath are not in their positions. This ties the company's operational stability directly to the debt agreements. The company also has to follow a bunch of rules. They can't take on too much new debt, can't transfer assets carelessly, and have to keep a certain amount of cash on hand at all times. If they don't have at least $5 million in cash or $8 million after July 2026, they could be in default. Also, the value of their investment in Lucid must stay above $20 million, and the debt to Lucid stock value ratio must stay below 65% or 50% later on. These are strict financial guardrails. Then there is the amendment agreement, dated the 3rd of February 2026. This agreement details how they settled the Series C preferred stock and refinanced the 2022 note. What is significant here is that the company granted the holder of that note the right to receive 300,000 shares of Lucid stock under certain conditions, like when the 2026 note is no longer outstanding. The sale of this Series D preferred stock is being done without registering it with the SEC. They are relying on an exemption that basically says since they only sold it to accredited investors who are buying it to hold, not to immediately flip it, and they took steps to control who gets it. They don't need full registration. This is a common way for companies to raise money quickly without the lengthy registration process. Under Regulation FD disclosure, they also announced these transactions in a press release on the 4th of February 2026. And as always, they list all the exhibits supporting these claims. We have the certificate of designations for the Series D preferred stock, the form of warrant, the form of the 2026 note, the amendment agreement, the registration rights agreement, and so on. Looking at these documents, it appears PAVmed Inc. is executing a significant financial maneuver not unlike a seasoned poker player. They've brought in $30 million in new capital through preferred stock and warrants, a move designed to strengthen their financial footing. They've also used this fresh cash to clean up some of their older debts, particularly the Series C preferred stock and the senior secured convertible note. This refinancing creates a new $15 million note, the 2026 note, a considerable obligation secured by most of their assets with a rather high 15% interest rate. The terms on this new debt are quite restrictive, with strict cash reserve requirements and a close watch on the value of their Lucid investment. It feels like they are betting heavily on Lucid's success to service this new debt. The Series D preferred stock has some interesting redemption clauses with escalating buyback prices that could put serious pressure on the company's cash flow in the coming years if triggered. This strategy essentially trades future uncertainty and potential high costs for immediate liquidity. It is a bold move that shows confidence in their ability to generate substantial returns, or perhaps a necessary step to avoid more immediate financial distress. The company is definitely playing a high-stakes game here, prioritizing operational flexibility and future growth potential over immediate debt reduction. Alright, that is our breakdown of PAVmed Inc's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.